Here with Roger Montgomery from the Montgomery Fund. Roger, thanks for joining us.
It's a pleasure, Mark. Great to be here.
Share market looks at best pretty expensive at the moment. Certainly no bargains, or not very many bargains out there. What would your advice be to investors on how they should be thinking about the share market right now?
Well, look, it's one man's opinion. I'm concerned that if you're buying today, the gains that might be made from a continuation of this chase for yield will ultimately be wiped out. We're now getting to the riskier end, the more speculative end of the hunt for yield. So when the United States Federal Reserve first cut rates to zero, people were scratching their heads about what would happen next, and historically, the whole point of quantitative easing was to get people to stop saving and force them into buying riskier assets so that the wealth effect would have an impact on people's consumption. What's happened is that there hasn't really been that improvement in consumption, but asset prices have gone up, namely shares and property. So as the prices started to move up, that dragged in more and more people, and that migration turned into a stampede, and the last phase is obviously a panic, a fear of missing out. And the very real concern is that what's happened is that share prices have disengaged from the profit performance of the underlying businesses. So the top 200 companies for half year 15, their revenue went up by 0.2% for the half compared to previous corresponding period, and reported profits went down 26% for the ASX 200 companies, but share prices went up. So there's been a disengagement. Prices are no longer engaged to or connected to the reality that our economy is doing poorly. Now, there's no relationship between the economic growth and the share market in any year. If the stock market goes up, if the economy grows faster than trend, 50% of the time the stock market does well, and 50% of the time the stock market does badly. Similarly, when the economy does poorly. So there's no relationship there. But the economy does drive profits for companies, and company profits are falling. But because interest rates are so low, share prices have gone up. So if the market simply turns its attention to the poor state of the economy, and investors who have been chasing yield are simply sated. In other words, it's not that they're selling stocks, they're just no longer buying them because they've bought enough, they feel like they've taken on enough risk. Then what you might find is that attention turns to the economy, and then Hillary Clinton steps on a landmine, heaven forbid, or something weird and left field and black swan happens, and that causes people to want to get out of stocks, and then the whole thing unravels. Now, we can predict with some confidence the profits of companies. We can predict with less confidence the economic outlook, and we can predict with no confidence when sentiment shifts.
Yes.
And at the moment, we're relying on sentiment. As long as sentiment remains positive, everything will be fine. But if sentiment shifts, everyone's going to be in a lot of trouble.
So what's your advice to somebody sitting in their living room at home watching this?
Yeah.
What would your advice be to them in terms of their share portfolio or their investment portfolio?
So if your time frame is a short time frame, and you believe that you're going to need all the money that you've got in the stock market within 2 years, then I would suggest starting to liquidate the portfolio, believe it or not, and that means just raising some cash.
Yep.
So if you're fully invested in the market, looking at the most expensive companies or the poorest quality companies in your portfolio and realising some gains on those. Now, that's sacrilege to financial planning, because you don't want to pay tax. But I would rather pay some tax than have a carry forward tax loss, which seems to be all the rage in Australia, right?
Yes.
You wait for a tax loss, you wait for a capital loss, then you can carry forward that tax loss, and that's when you sell. You don't sell when you're showing the profit. That's not how you should invest. You shouldn't invest based on tax. So you take your most expensive companies off the table, so to speak. I hate using that expression.
Yeah.
And the poorer quality companies, they're the things that you might want to think about selling. That doesn't mean the share market won't keep going up. It's just that, as I said earlier, sentiment can shift very quickly, and I'd rather be 6 months early than 6 minutes late.
Roger, that's good advice. Thanks very much for your time and appreciate your comments.
It's a pleasure.